Okay, all we find ourselves in sort of a good news, bad news situation. The bad news is yes, there is a third slide deck for us to get to, but the good news is this is the last one for tonight, and it's not very long. So hopefully, I did have some um technical issues in my last class. Hopefully, if these videos work the way they should, you can space this out over the course of a week and you don't have to suffer all of this in one night, but we'll do our best, okay? So we talked about the accounting equation and we talked about the different kinds of transactions you can have, right? Now we're going to talk about how we actually record those financial events that happen in our day-to-day business. Okay, so the transaction itself is going to be our starting point. Let me share my screen with you real quick. Okay, there we go. Let's move this out of the way so I can see what I'm doing. And okay. So our starting point is going to be these transactions or events that are occurring. Okay, so we need to identify what those transactions are. And we usually do that using source documents. So an invoice or a receipt or something that documents that something financial has happened. Okay, so we analyze that transaction and then we use the accounting equation to kind of figure out where it's going to go. All right, we record all of the relevant transactions into a journal. Okay. Now we use this archaic language, but really what we mean is our accounting program on a computer. Okay. Um, all of that information. So we're going to make these journal entries. And that's going to roll up into the ledger accounts. Okay. So you have all these sales that you make in the day. If you have a sales type business, an inventory based um, sales business. So all throughout the day, you're selling different items. Each one of those sales to each person is going to be a transaction, right? And we bundle them all up into the sales ledger, which is for the accounting period, all the sales that we've done. Okay. And then we use those ledgers to create what we call a trial balance at the end of the period, and that goes into our financial statements. Okay, so a little more vocabulary for you guys. An account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense. Okay. And then the general ledger is a record of all the accounts and their balances. So here, words in pictures. Okay. This is just showing you what the different accounts look like. So for assets, that's things that we own. We have things like cash and land and supplies and inventory. Okay, that equals liabilities plus equity. In our liability accounts, those are things that we owe. Okay, we have our accounts payable, our notes payable, our unearned revenue. Then we have equity. Okay, this is the money that we put into our business. We got the owner's capital, the owner's withdrawals, we have our revenues and expenses. Okay, so again, all these are different types of asset accounts. All of these are the different types of liability accounts and are different types of equity accounts. Okay. So our revenue and common stock increase our equity. So that's money that people put in, right? Revenues are the money we get from our day-to-day business. Common stock, that's money that, people buy our stock, they give us money for a piece of our company, okay? Expenses, we all know what those are, and dividends, that's when we're paying out some of our revenue to our shareholders, and both of those are going to decrease our revenue. I'm sorry, decrease our equity. Okay. Um, our ledger is a collection of all the accounts and their balances, which I said earlier. Okay. Depending on how large your company is, it will have, more or less accounts, right? Also, depending on the type of business that they do. Here are a few of the types of accounts that you might experience and the numbering convention. There's no law, this isn't GAAP, there's no law that says that you have to number your accounts this way, but out of convention, this is the way we usually do it, okay? So asset accounts are usually in the 100s. We tend to list them in order of liquidity. Okay, that is how quickly we can convert them into cash, just like we do on the financial statements. But again, there's no law that governs how you list your accounts. Okay, our liabilities tend to be the 200s. Equity accounts, our capital accounts tend to be the 300s, revenue in the 400s, and expenses in the 600s. Okay, so we have this idea of debits and credits, okay? And it stems from this presentation of a T account. Okay, so back in the old days, when accounting was done in giant tomes in a ledger book that had like two columns, the left side is called debit and the right side is called credit. Okay, and depending on which side you put the numbers on, that shows you the effect of the transaction, whether it increases that account or decreases it. So again, you have assets equal to liability plus equity. Assets are on the left, okay? So it increases with a debit, which is on the left, and decreases with a credit. That's on the right. All right, so liabilities, they are on the right, okay? That means that you increase them by putting the number on the right and decrease it by putting it on the left. Same with equity, because it's on the right side of the equation. Okay, but when we expand that out, we see that for owner withdrawals, that's a contra account, okay? That interacts with this owner's capital. So because this is a negative, a drawing out of the cash that's in the owner's capital, we increase our withdrawals on the left-hand side and decrease it on the right. Same with expenses, because it reduces overall equity. It increases on the left and decreases on the right. Those are the two like standout differences. You just have to remember those two. This slide sums it up for you. Really good slide for study purposes, okay? Um, so the account balance, all right, that is the difference between the increases and the decreases in that account. So the example they give here is your cash account, okay? On the left, we have our increases. On the right, we have our decreases. Okay, we've got it in this T account format. All right. We receive investments from the owner. We get money for giving it consulting services. We collect on an accounts receivable. All of these increase our cash. When we purchase things, we're decreasing our cash, right? Because we're outlaying cash to get stuff. We pay our people. Um, we with our owner of the company withdraws some money to pay himself. Okay, all of these reduce our overall cash. So the difference between these two sides is going to give us the overall balance. Okay, this is a concept we're used to. It's just like your bank account. Okay, money is added, money subtracted, but at the end of the month, the amount that's on your statement is your balance, what's left in your account after those transactions. That is it for chapter 2. Okay, so we are done with week 1. Yay, you made it. Um, please reach out to me if you have any questions about anything. I am here to help you. Okay? Let me stop this.